Joining us now to talk about how investors can navigate through all of these uncertainties, from Syria to oil to emerging markets. Jeff Kleintop with us tonight, Chief Market Strategist at LPL Financial. Jeff, good to see you again.
Thanks for having me on.
We've built quite a wall of worry for investors to think about right now. Should they be concerned? I mean, we're going into the fall. We didn't even get to the tapering. We got the possibility of a debt ceiling crisis as well. Should investors be concerned?
Well, I think it's understandable why they might be feeling uncommitted here, with the Fed committed to tapering and the U.S. committed to military action in Syria and the Congress committed to fighting over the debt ceiling. All those issues have left investors on the sidelines. Listen, it's taken a long time for individual investors just to get back to even after the losses of 5 years ago, and it's understandable they may be a bit cautious here. We don't see a major pullback here of 10 or 20%, maybe another one of these 5 or 10% moves, which maybe we're halfway through already. But investors who want a hedge in their portfolio, who aren't willing to ride through this volatility, may look to gold, may look to oil as effective hedges in their portfolio. They tend to go up when when geopolitical risk rises, but you've got to be quick in getting back out again, because once decisive U.S. military action takes place, they quickly reverse course.
But Jeff, getting back to some of the political risks here, talk us through what the market reaction would be if there is any military action, if it's prolonged, or if there's some kind of diplomatic resolution. What can investors expect in those scenarios?
Sure. It's interesting. It seems to be, now that we're committed to some military action, the faster it gets over with, a decisive strike seems to be the best reaction for the markets, at least looking back historically. Sometimes the markets don't react. In 99 in Serbia, in 95 in Bosnia, it didn't really affect the markets. But if you look back to other events, the Gulf War is a great example. From when we pre-committed to action in August of 1990 to where we actually took action in January of 1991, stocks fell. Once action was taken, stocks rose. So I think if we take action and it's decisive, stocks will begin to turn around on that. It's that lag between when we're pre-committed and do it that's the drag. I think today's lift in the stock market tied to maybe Defense Secretary Chuck Hagel's comments that it might just be days away rather than weeks away. But if there's some other diplomatic solution, that could be a positive as well. But again, it needs to be decisive and clear-cut, or this will linger over the markets, along with all those other issues we talked about, the debt ceiling and the tapering.
Right. Now, that's the stock market. What about interest rates and the Treasury market? As we know, as the markets anticipate tapering, yields have been going up. But when they fear this military action against Syria, yields go down. So which way do you think they're going here in the near term?
But they didn't come back much. That's what's interesting. They came back a little bit, but I think they are headed higher. I think even in the face of this military intervention, which may not be that decisive, it may take place over the course of several weeks. I still think yields are probably headed higher, though not dramatically so, simply because it's the economy that matters here. It's domestic concerns, not foreign ones, that cause the stock market pullback and I think are affecting the bond market
Jeff,
as well.
Real quick question, because we have to go now. What about cash? Is it wise to put some money into cash now, sell out some stocks?
I don't think so. Cash is still earning a negative real return. I think investors here need to stay committed to their long-term asset allocation.
Jeff Kleintop of LPL Financial. Good to see you again. Thanks for joining us tonight.
Great to see you.